somehow drives that people should somehow sell, but they don't sell. The quote basically says, contrary to the traditional investment literature, profit expectancy, so the amount of money we will make by investing in this particular asset, is not a necessary condition to the extent that there is one empirical configuration of motivations that explains that individuals also invest in Bitcoin, even if they do not expect profits. What should we do with that? We have financial researchers, which is in finance, asset managers, portfolio managers, trying to anticipate how cryptocurrencies are going to develop in order to predict returns and try to outperform the market. But on the other side, we have hodlers, people that simply keep Bitcoin or other cryptocurrencies when, according to rational considerations, they should sell, or the other way around. What is the consequence of basically this mess? That future research is needed. Paper from Intelligent Systems in Accounting, Finance and Management, published last year, generating an accurate prediction model for such a complex problem, anticipating returns of cryptos, is very challenging. The problem of cryptocurrency price prediction is still in its nascent stages and requires further research efforts to explore this area. So the reality here, let's say, knowledge spill that we get from here, whenever I say knowledge spill, is like, attention, there's an important sentence coming here, is that we just know too little about this market. And we know even less when we try to anticipate returns in cryptocurrencies than what we know when we try to basically anticipate the returns of traditional financial markets. Now, that we know nothing or little about it is one thing. The other question, or the other thing, is why should we care? Well, because if we somehow manage to better understand this market, then we will be able to navigate this table in a much better way. What is this table? Well, this table shows us the monthly returns from investing in Bitcoin since January 2016 until basically last month. Whenever we have a blue square here, it says that if you buy on the first day of the month and you sell by the last day of the month, then you made some money. If you have a red square here, it means that when you did the same, then you lost some money. On average and in total, it seems very nice. But if we are able to anticipate these red squares here, then what we would say is, okay, by March 1st, 2017, I will sell my Bitcoins and wait until the end of the month to avoid losing more than 9% of the value of my asset. So it's not only that we know little about the problem, it's also that this seems to be a very relevant problem. Asset managers, investors, and so forth, and so on. Now, when we know very little about this, about how to anticipate the returns of an asset, there's something we can do, which is try to anticipate something called regime changes. Regime changes are basically very sharp increases or decreases in the price or in the returns of the asset. So instead of just trying to say or to anticipate how is the price of Bitcoin or Luna going to be by the end of next month, let's say, okay, when is the price somehow going to increase very sharply or somehow decrease very sharply? This, by the way, and the anticipation of regime changes is fundamental for asset managers because they optimize their portfolios based on the regime where the asset actually is. So a very, very relevant problem. And this is basically what I just explained. What is a regime change? An abrupt change in the tendency of the market that if you're able to anticipate as an asset manager, as a holder of the asset, you somehow get a very interesting advantage and you can turn the somehow red squares into blue squares for you. Now, when we speak about regime changes, there is a very famous, notorious model that helps us to predict them. And this is the log periodic power law model, LPPL model. This is a model developed a couple of years ago that basically works very nicely or very well to anticipate regime changes in the traditional financial market whenever there is no massive, let's say, external shock like COVID outbreak, pandemic. It's basically based on the rationality of investors and using simply previous prices of the assets anticipates the date or the period in time where the market is either going to crash or going to sharply increase. Now, the question is, why don't we use the LPTL model simply to the crypto market? We applied there. Just by the way, little anecdote, and this is Professor Sornet from the ETH Zurich. He has the model is so widely used and so popular that he has given a TED talk about it, and he has more than 1.5 million views. It's a fantastic model, works very, very nicely. Now, the issue is that we cannot apply this model to cryptocurrencies. Why not? Because apparently, cryptocurrency investors are not rational. So if they are not rational, then the traditional rules whereby the model works will simply not apply. And therefore, the model will not work as good as it works for traditional financial markets. And this has been identified by Sornet himself, the developer, the brain behind that model. This model has been deemed as not as applicable to the cryptocurrency market as it is to traditional financial markets, right? So, big challenge. We want to somehow better anticipate the returns, the prices of cryptocurrencies. There is a fantastic model to anticipate those regime changes, but we cannot use them. And that's our problem. That's our research gap. Please go ahead.
Yeah, fantastic talk. So I've got one question about regime change, these constructs. What is the fundamental difference between predicting regime change with predicting price? Because regime change is also based on price, right?
Very, very good question. Instead of simply saying, okay, how is the price going to develop? We don't focus in small increases or decreases. We just try to predict, to anticipate a category. Regime change, yes or no. Positive regime change, no regime change, negative regime change. So we turn a continuous problem into a categorical problem with just 3 states.
You're not using regime change in the sort of mean reversionary sense, that there is some sort of mean and then the mean changes. You're not using it in that sense.
Not particularly. It's what we somehow try to mimic, but we are in a very, very early stage. So what you're going to see, I think even in the next slide, is that we define regime changes as basically a positive one, as an increase of more than 10% in next week's returns. So that's our definition of the category, being positive, negative, or no one at all. And our approach here, I don't know if you want to follow up.
No, fine. Just checking.
Yes, go ahead.
Another question. How do you define a cryptocurrency investor? Because you started from the assumption that they are not rational, but we know that the cryptocurrency investors are very different. Like we have us, you can say in this room, or you can have the so-called whales, that are maybe following different rationals. So,
there is a very
that they are not rational on board is
very good question. There is a recent paper that has made a category of 6 different types of cryptocurrency investors. From the, let's say, the new ways that just read about it in the newspaper, download a wallet and invest £50, to the whales, institutional investors, miners, and so forth and so on. This is actually the paper that says that some of them are not rational. JP Morgan, of course, is a rational investor if JP Morgan is holding Bitcoin, right, or Ethereum. However, there is a significant amount of the population that behaves in a non-rational way.
Can I perhaps work with you to refine the definition of rational here? We typically in financial markets talk about maximizing some combination of risk and return for some investment. However, outside financial markets, there are vanity investments such as fine wines, cars, and art, where the utility function of the participant is sometimes to impress other people with their connoisseurship, their knowledge, their wisdom, etc. And actually, they're prepared to accept appalling risk return or negative returns merely for their external utility.
Very interesting approach. We are not considering them, or the paper is not considering rational in the sense that they are not optimizing returns given a certain risk level or volatility level. So the whole signaling aspect in that sense wouldn't be considered here within rational. Maybe it's just rational to hold the latest cryptocurrency to show that you are completely up to date, even if you lose some money. But if you consider this so it's pure financial utility in a very traditional way. Good. That sense. Okay, so what do we do? Say, okay, let's train a machine learning model, machine learning algorithm. In this case, it's going to be a random forest model to try to anticipate the state of the next week's returns. So basically, how are we going to have a regime change next week? If yes, is it going to be a positive one? If no, is it going to be a negative one? So machine learning model in that sense, with a twofold objective, right? And we're going to apply this to Bitcoin, to returns in Bitcoin, and to returns in Luna, right? Because when we started a project some months ago, we just had the crash, and we thought it would be very interesting to observe that, right? See how the model performs there. Yes, and this is relevant. I mean, in terms of research, of course, to better understand the way markets function. In terms of practice application, well, needless to say, you would make some money. So we feed the model with some features or variables, many of them very traditional macro variables like expected inflation, consumption index, money supply, different indices, commodity prices, and so forth and so on. And additionally, in order to try, that's our somehow hypothesis, to accommodate this non-rationality, we conduct a series of sentiment analysis on 3 different sources. And the first source that we use is Reddit. And in Reddit, what we do is to search in the sub-channels our Bitcoin, our Terra Luna, and we search for 4 terms: Bitcoin, Luna, GM, which stands for good morning in the lingo of the community, and what means we are all gonna make it, which are concepts that you tend to read a lot in these types of forums, and that somehow we think that they somehow give us an indication about the sentiment of the people. Maybe they are rational, maybe they are not, but maybe somehow holding Luna becomes a negative signal. But you don't want to hold Luna just when in the turmoil of the stock, right? So it's actually very interesting comment. And then we analyze all those texts, all those posts in Reddit that contain one of these terms. Needless to say, when we are predicting the Bitcoin returns, we will use Bitcoin and not Luna, the other way around. And then we apply some natural language processing algorithms just to analyze the sentiment of it. And we incorporate those sentiments as features or variables in our machine learning model. Additionally, we just looked at the frequency with which those terms are searched in Google, and then we get a number between 0 and 1 for the Google trend. And we also apply an analysis on tweets. So we looked at all those tweets containing those terms, either in a written form or in a hashtag form, and we apply the same libraries to derive the sentiments. So basically, what we have is the traditional macro variables plus some variables that we consider eventually maybe will give some kind of information in a random forest model to try to anticipate these 3 states. Precisely the period that we analyzed for Bitcoin is between January 1st, 2015 and June 15, 2020, so this year. And for Luna, we do it since July 2010. And what we use is a forward chain approach in order to naturally only use data that has not yet occurred, right? So we don't use future prices, to anticipate future prices. So everything works in a kind of out of sample way. And finally, here are the results. So these are the results of our model with and without sentiment analysis for Bitcoin and Luna in terms of accuracy, recall, and precision. Just the recall is basically out of those that occur, out of those that are regime changes, how many do we get? And the precision is out of those that we deem as regime changes, which ones are actually regime changes. And what we see is that, well, the results are not too bad. And what we consider interesting is that incorporating the sentiment analysis improves our result in that sense. And I have the next slide in which I compare the difference between these metrics with and without sentiment analysis. And this is basically the improvement in absolute terms, so the actual increase in the accuracy, recall, and precision when incorporating the sentiment analysis.
how are you incorporating false positives and false negatives into, when you go to see?
When we simply compare if
Yeah.
the actual price, the actual change was above or below 10%,
Oh, right, okay. All right,
and that's
okay.
and we compare it with our calculation. And we think that it is interesting. It somehow says, well, naturally, in any financial market, incorporating sentiment analysis can be useful. And we say, okay, in this case, it is useful too. The next step in this, what we want to do now, is to compare the same approach for the traditional market, the traditional financial market, and then compare these metrics to see if incorporating sentiment analysis is more, less, or equally helpful when anticipating cryptocurrency returns than it is in the traditional financial market. So that's future work. But in this case, we say, okay, the results are not bad at all. Okay, recalls and precisions of around 72, 83%, and improvements when incorporating the sentiment analysis. So it's kind of a solution, kind of an approach to say, okay, maybe the traditional rules don't apply for cryptocurrency investors, but here's a way to somehow mitigate that. And then we compare our model with the LPPL model, with the famous model that works so well in the traditional financial market. And what we see is a very significant improvement in those terms. It would be our model with sentiment analysis. This would be the LPPL model. And in the next slide here, we have the improvement, again, in absolute terms. So it's the actual increase in the accuracy, the recall, and the precision. So yes, LPPL model struggles, also in words of the author of the paper of the model. And here we have kind of an approach in order to somehow mimic what the LPPL model does, incorporating new variables. And then we say, okay, our machine learning model can not only be used in order to predict states, positive regime change, no regime change, negative regime change, but to predict weekly, monthly, yearly returns. So instead of keeping in the, let's say, simple part of the problem, which is just a categorical problem, let's go to a kind of continuous problem again. And then we do it, and we observe these R-squared values for our different models with sentiment and without sentiment, having here again the change in absolute terms. So it says, okay, the R-squared value is not fantastic. It's not something that we can somehow sell, but when we apply it out of sample to the market, this is what we observe. In the first graph, we have the Bitcoin returns fitted in blue, so our prediction, and the historical in black, what actually happened. These are weekly returns. And here we have it for Luna. And what somehow we find very enjoyable is that the trend follows the actual returns quite nicely. And we are able here in the massive Luna crash to anticipate that too. So somehow the model has something that seems to work nicely in that sense. So what have we done? We come from the problems that we observe in industry. It's very difficult to forecast the returns of cryptocurrencies. So, okay, let's focus on regime changes. LPPL model cannot work, or is somehow limited. Assuming that cryptocurrency investors, or some of them, are not rational, well, then let's try brute force machine learning in order to solve the issue and incorporate sentiment analysis to accommodate that potential irrationality, or let's say different attitude towards losses, utility, etc. And the results we think that are not too bad. Next step that we want to do, compare everything with the traditional financial market, S&P 500, for example, and see if the sentiment analysis is more valuable in the crypto world than it is in the traditional world. And if it continues working, maybe create kind of a portfolio strategy based on these results. Very simple one, right? If the prediction says you're going to win next week, buy or keep. If the prediction says you're going to lose, just sell this week and wait until next week and see how much money we make or lose after some weeks. And this would be basically it. I don't know if we will be able to anticipate the next regime change, but we've had a lot of fun, and we would definitely welcome your criticism, suggestions for the future very, very much. Thank you. I don't know, if you have something burning, if I bored you to death and you're just still willing to escape as soon as possible, or if you have any kind of suggestion now or later.
It seems like there are many sentiment analysis papers out there in the market.
Yes.
So what is your latest difference with those sentiment analysis?
Yes, we apply them to regime changes, and so far we couldn't find any, right, for regime changes in the cryptocurrency market. And we are somehow linking this with this assumption of these results that cryptocurrency investors don't seem to be very rational. So we try to take it from this angle and say, okay, what can we find out? Something that we could do also in the future is to say, okay, what can we actually learn from the sentiment analysis? If there's some kind of indicator there that will say, now the sentiment will change, yes, no. So then why, answering the why question, that would be the next step.
Thank you for a wonderful presentation. And so firstly, I have no background in machine learning. So my question might sound stupid, but could you tell me, I guess you're right, you can have like roughly 80% possibility to make 10% return every week using your model.
Did you say by?
So like your accuracy and precision is roughly 80%.
Not really. That's not the message. That wouldn't be the message. The message here is basically how many of the regime changes can we anticipate? And in that sense, 80% would be, or 80% would actually be how many of regime changes and not predicted regime changes we get correct. So in order to be completely transparent and humble, 20% of the times we miss it. So 20% of the times we say no regime change, and then eventually there is a regime change. Or we say negative regime change, and then there is a positive regime change. It's just 80% of the weeks we're right.
So yeah, so that's my message. Like in the long run, you will have 18%. So 80% of the time.
Yes.
It's right. So you can make 10% profits.
But then we need the market changes for 10%.
Oh,
So if you have a black market,
Yeah.
anticipate that.
You also have an investment problem. There's a thing called the Kelly criteria, which is that if you have a given probability of a return distributed normally to across some distribution, you have to make a very hard decision as to what is your optimal bet. Because if you, at one extreme, if you bet nothing, therefore you make no return. If on the other hand, you bet 100% of your endowment of capital, you will, on this model, go bust within, I would guess, 6 weeks, basically, because although you're right 80% of the time, you're wrong 20% of the time. And you can pretty much guarantee that we know that there are 2 zeros, and we know there's an up, so there must be at least one maximum within that curve. And if you're going to reinvest your money, you need to be able to do some form of optimal risk taking, optimal bet. It is a bet in a sense. And we use gambling, the economics of gambling. So
Absolutely. It has a lot to do with this concept of ergodicity, right?
Yeah.
Maybe some of you have read this book, Black Swan. Taleb explains it in a very nicely way there, although it's not from Taleb.
Yeah, he was a woman. I have to ask this question. And there's 2 related questions. One is quite normal, which is that have you looked at weighting some form of influence? Because a big thing within these markets is that certain players have more influence. So that's the first question. The second one is that have you looked at just simple keyword matching rather than sentiment analysis? Simply look for certain keywords that correlate with regime changes or changes. And lastly, the most difficult question is based on something I wrote a while back. Inevitably, if you are able to identify sentiments, this is a feedback loop. These people are talking to each other.
Yes.
So therefore, it is possible to manipulate the market. Once you identify sentiments that move the market, you can move the market because it is a market based on terror, fear, greed, and showing off to your friends.
Brilliant question. Thank you very much. So regarding the first one, the only thing we wait for the moment that tweets. So we weight the tweet, or say the sentiment that emerges from the tweet, by the amount of retweets and likes that the tweet has. So that's the only actual weighting that we do. In terms of which concepts we use, that's completely out of the blue. We just got. So it would be very interesting to actually do some kind of search in that sense. And the third one, it's absolutely right what you're saying. So and I would even go one step further. Let's assume that everyone would serve this model and it works, right? Then by doing the measure, we are altering the market.
Yes.
Just by publishing. It's like a little bit of a Heisenberg problem there, right? So in the moment in which you measure it, we change it. And then what do? Then our model, our output becomes a signal in itself. And then the Pandora box is open. We're not yet there, right? But how would you suggest dealing with that, if at all? Is it something we can do because this would just naturally happen? Right?
Well, of course, what you then would have is latency arbitrage.
Yeah.
My model running faster than your model over a shorter connection.
Yeah.
So we'd have AIs running in. Yeah, that would really push up the energy consumption of Bitcoin.
So if I have the model and it's fantastic and I will have fantastic accuracy or precision, then I'll do arbitrage, of course, and then I'll move the market myself. And then the price will just faster reach that point. But
Assuming that, but it's
Assuming that
using
happens.
rationality in your sense, given the absence of that sort of rationality, there isn't a point for it to reach. It's not based, as far as we can tell, on external factors. If we just take the price of oil is bounces around with many factors, but there is a level it's seeking towards at any point in time. I can't think of any level that Bitcoin or Luna is seeking towards at any point in time.
So just thinking out loud, right? So let's assume I have the model and I have an infinite arbitrage capacity. And as my model says, okay, next week you are going to make massive return. Then I would buy right now as much as I could, and I would just reach that price faster today. But then next week I won't have it anymore.
And then that's another optimization, because market impact modeling, as we do have in FX,
Yeah.
there would be an and people, although people, it's very hard because of the lack of that level of rationality. But given the way the prices are, it's likely that the prices would move against you quite hard if you applied it instantly. So there's an optimization of
The time.
applying it. If you applied infinite value, the blockchain, I mean, and the transaction speed, basically.
Yeah.
But even if there was such a transaction speed thing, the market, there would, people like yourselves would find it. And there isn't a level it's moving towards. There is no, people have done studies on mean reversion. I don't know if we've seen one that actually found it,
No, not really.
which implies there is no level. I struggle to think in markets like that.
Yes. I've been very afraid in the last weeks when the price of Bitcoin was going down, and I really asked at some point, and I've been observing the market for many years now. I was thinking like, is this really going to be it? Is this going to be it? Because now more investors, institutional, the rational ones are there. Yes, no, right. Doesn't seem for the moment. It seems like we are somehow not floor around 2019. Let's see.
Yeah, I just think of one, probably quite fundamental paradox here. If you use sentiment analysis to predict regime change, right? So when you define regime change, it is abrupt change. Sentiment, the public sentiment is highly hinging on the market movement of the crypto prices, right? So if we think about it from a logical perspective, it is quite unlikely that we can predict a regime change, abrupt regime change based on public sentiment. For example, like the Luna example, right? The Luna crashes all of a sudden.
It
So
takes
before
some
that,
days,
all
right?
the sentiment about it is quite positive. So if we base our analysis on sentiment, so we will never be able to predict the crash of Luna.
Honestly, I don't have any data to give you a proper answer there, but my assumption is that there is a time lag that you need until the, let's say, the negative attitude reaches
Yeah.
that critical mass, right?
So you can only predict the regime change after the regime change occurs and the public sentiment just changes.
I would
Something.
completely agree with you that once it crashes, the sentiment is very bad.
Yeah.
While it's crashing, when it's about to crash, then there are already some changes in the attitude. This is my co-authors here. They do a daily tracking of the sentiment towards cryptos, and it fluctuates quite fast. So even before the actual crash happens, you start seeing a low tendency, and then when the sentiment reaches a certain threshold, then boom, abruptly you see the change. So there is a beginning there, and then it's very behavioral.
There are some classical market dynamics which haven't happened yet, but the mechanisms for them are existing. In the sort of the left-hand side of your graph, people owned blockchain and they bought and sold it. Therefore, your exposure, and for lots of people, it was money they didn't care about. They weren't betting their houses.
That's a very good
Money,
point.
it was a game. I mean, to an extent, Bitcoin is better model as Call of Duty as a financial market.
Yeah.
But that was when people just had simple long positions. Serious market crashes, 1929, 87, etc., come from when the market participants move from people playing at it or whatever, speculators, to when people must buy or must sell because they've taken out a derivative position, a future or a sold short, and the market may force them to sell. And those market dynamics have feedback terms. And I'm part of me is wondering whether the latest downturn was actually due to the fact that we now have poor, but not very good derivative markets in Bitcoin, but there are now derivative markets, there are now futures, there are now going short on Bitcoin, which I think is possibly the maddest any investment opportunity anyone's offered me. But
It's an interesting, it's an interesting future research question, a very interesting one.
Yes, couple of questions.
Go ahead, please.
So first of all, how many regime changes do you observe in the Bitcoin industry?
Very good question. I had the number in the paper, but I haven't included
Like
it.
100 or
No, it's less. It's I cannot tell you a number. Sorry,
maybe less than 100.
it's less than 100. Yeah.
So since 2020.
Yeah.
And do you have data about sentiment analysis since 2015, right?
Yes.
On Reddit and
Yes.
Twitter?
But for Luna, only since
Yeah.
July 19th. Because it's Google Trends, it's Reddit, and it's Twitter.
Okay. And how long does it last, a regime change? So since I don't know, I think it's not just one day you say, okay, this is a regime
Our
change.
definition of the regime change is very simple. It's very rudimentary, primitive, right? It's simply a change of more than 10% in the return compared to last week.
Okay, so
It's just like
for each week.
it's like a
So
like a
it's
step.
just at the beginning of the week, you say, okay.
now I
this
buy,
week,
now I sell on Sunday at
and
evening.
then if during the week there is a
Exactly.
change in.
One thing where we have a lot of freedom to play around, we should like operationalize this, is in how do we define it, right? 10%, 5%, 3%, 20%, 1 week, monthly, 3 days, yearly. There are many variants there, but we started doing this a month ago.
Another question, you try the analysis only with the sentiment analysis? Because you tried with the financial market, financial plus sentiment, on sentiment.
No, what we do, and we show it in the table, is only macro variables, and then macro variables and sentiment.
Because maybe like sentiment by itself is better than with the macro, I don't know.
I would doubt it because of these results,
You're not sure,
but it's a good.
and also about that, like you can have sentiment, but probably you can have, for example, you are analyzing Bitcoin. You could, for example, include in the analysis something that is specific for Bitcoin, like the price of energy in a specific area of the world, or I don't know, something else.
Yeah, more fundamental.
Yeah, exactly. It's from Bitcoin fundamental.
Absolutely. This is the first very brute force step that we have done in this
Yeah,
area, right? So we say macro variables and these terms, right? But why GM and not something different?
And this is one set of sentiment. It's not all sentiment analysis gives you these numbers. This is your first cut of sentiment analysis. Presumably, we're tuning that number would go up.
Hopefully.
Could go down.
Currently, we have some questions online.
Oh, great.
To share those as well. So many is asking, to what extent do you take the regulatory approach of a certain country into consideration in your model?
So in this model, not at all. Zero. Just thinking about what would be a good way to, because the aim is to do this in an automatic way, right? So we don't want to be curating what the lawyer said or a commission, right? Probably this would at some point emerge in the sentence, right? Let's assume the European Union bans crypto mining, bans Bitcoin mining. What this will be reflected in Twitter, for sure, right? The question is what happens there if Google Trends increases a lot and then Twitter sentiments go down heavily. We would need also to do some kind of cleaning in our sentiment. Maybe Google Trends is just rubbish. Right? Twitter is fantastic, or Reddit. So my assumption, I guess, is this will be somehow reflected in the sentiment. It is something that people really observe and read in the newspaper.
And there's another question online. Hi, may I ask you how you select the lag variables for training the model, which make a very good out of sample fitting for Bitcoin, but slightly delayed for Luna, even if it's good enough for the volatility of Luna?
We just took a 1 week lag, very simple to get. I don't know if this question satisfies the person asking, but happy to open the just again, very, very primitive approach.
Your features selection, range of causality,
We took what other models have done previously. So very standard already, say, tested macro variables, we just put them there. But we haven't done any kind of filtering or anything there.
Was there any sort of, I mean, in terms of tuning your sentiment analysis, what sort of time-based weighting, or did you just take snapshots over the previous week? But for the set of text,
We check the previous week.
straight week,
Yeah.
but this is the first cut, no weighting.
No weighting at all, except in Twitter. So in Twitter, we say by the end of the week, amount of retweets and amount of likes of that tweet. And that's the weighting.
So there's presumably quite a bit of gain to be got from some sort of weighting type approach.
Yes.
So you tested the model on Bitcoin.
Exactly.
Is it just one model, or would there separate models for Bitcoin?
The model is the same. And the only difference is that in the Bitcoin model, as features, we have the Bitcoin term for the sentiment. And in Luna, we have Luna and not Bitcoin. So we exclude Bitcoin in Luna and Luna in Bitcoin. Which makes me now think, why not including both?
Oh yeah, because I was going to ask.
Exactly, Bitcoin will definitely influence Luna and Luna will influence Bitcoin.
Another question. About Luna. Yes. Because I don't know if could be a good example to use, probably because the crash of Luna is a very specific crash.
Yes, it is.
And so it could be like, okay, if you want to predict the crash of Luna with sentiment analysis, could be interesting, but it's very particular. And at this point, I will include also something about Terra.
Mhm.
So the price of Terra that is collapsing probably is going faster than the sentiment analysis. Like as a, I don't know, it's just
I don't know.
because, but I would include it because they are of course super related.
Yeah.
And then for the traditional financial market, could be interesting to use or to analyze or include in the analysis also what happened to GameStop.
Oh, yes.
So all because we are starting to see the same dynamic also on the traditional financial markets, so it's interesting.
Very good point. I think this is a ramification of this work. Now we have a lot of platforms that enable people to not only invest in cryptocurrencies in a very easy way, but also in any type of asset, right? So you know the many that are out there, right? And this has enabled that my aunt, who is 65 and lives in Madrid and knows nothing about finance, plays around and as if it was game, right? Is she rational? Isn't she? Which signals does she read in order to form her decision? So is this just changing the way that the market works? Probably yes. Should we pay more attention to other alternative sources of information like Reddit, Twitter, whatever she reads, right? And then incorporate that? Probably. Is the rationale, whatever we consider rational, of our generation the same as the generation of our parents? Will this change in 10 years from now when teenagers now start just playing around with some money, putting it there? Can they move the market? Questions that will come. And the whole Web3 economy, in my opinion, is fascinating for these kind of things. There's people that have stopped working just to play games in Indonesia because they make more money in crypto by passing, by advancing in the game than they do working in a bar. So when people stop working in the real world because they make more money playing video games in cryptocurrency, how are they going to treat this currency? Are they going to just immediately change it? Are they just going to keep it? They need to somehow reinvest it in the game to buy better weapons, better skins. It's a brand new world. What is the rationale there? Maybe you need to save some money in crypto because otherwise you won't continue advancing in the game because you will really need that sword in that game. So right now, what happens? Then we have to incorporate metrics about what happens in those very broadly used games in order to better anticipate the price of those cryptos. Just to open the box. I think it's very interesting.
So I suppose in your robustness checks, you have changed the weekly window in the starting point and the ending points, right?
From Monday to Sunday.
Yeah, because you need to, to move the the framing, the window, timing window, dynamically to check the robustness of the results.
Yes.
So have you done this?
What we did is to count or start the week in different days.
Yeah.
And the results don't change for us. So it doesn't matter if you start the week on Monday at 000 or on Tuesday or say Friday at 5 p.m.
So your model performs better than the LLPR model consistently. For example, this.
Yes. Although the LPPR model, it's more meant for longer term, right? So for weekly. We are not playing fair. We're not being fair to the LPPR model because it's not meant for that, right? We just take it as basis because we wanted to use it. Then we realize, oh, we cannot use it. So this is not a criticism to the LPPR model. It's just because it doesn't work here. Also in words of the author, what do we do? And a little approach to mitigate that.
You asked about the model, what happens if this model is predicted? And of course, the LPPR model is of itself a market factor like that because fund managers do not want to underperform on other fund managers. They're not so keen on actual performance. It therefore becomes the model that, the LPPR, if some derivative of this could become the LPPR model and therefore be self-defined.
That's true. Making mental notes of all the comments.
Well, they're being recorded.
Oh, fantastic. Then I'll believe it. Okay, I don't know if this is it. Thank you very much. It was a pleasure. Thank you. I made some changes to the presentation. Could you send it to me? The one that you have?
Yes. So you are research and finance.
Okay, so thank you very much. The next seminar, if online, will take place last Thursday of next month. But to be updated as to where we will, as to when next month, you can look at our newsletter. Thank you very much.
A work